When it comes to options trading, you must know your deltas. You must know the delta on each and every options that you buy or sell. If they're part of a spread, you need to know each option's individual delta as well as the total delta of the overall spread, because delta tells you everything. It tells you if you're leaning long, you're leaning short, right, as far as bullish or bearish. It tells you if your probability of profit on the trade is really high or really low. It tells you your risk on the trade, essentially. Now, I've done videos in the past on delta. I've actually covered all the 4 primary Greeks on camera before: delta, theta, gamma, vega. Check out those videos if you haven't checked them out already. But delta is by far the most important Greek. It tells you, well, it tells you a lot. It tells you your probability of finishing in the money. It tells you whether you're bullish or bearish. We've already talked about it. It tells you which direction you're leaning. It also is a share equivalency. It tells you what's your position, how it equates in terms of being long or short shares of stock of the underlying. So a quick recap of what delta is. Delta is the theoretical estimate of how much an option's value will change if the underlying stock moves up or down by $1, assuming all other factors are held constant. So when a stock moves up or down by $1, the delta tells you how much money you're going to lose on that. For example, if I go into my trading platform, of course I'm using TASTYTRADE. Let me find an option here. How about this short put? This short put has 6 positive deltas because it's a short put. It always has positive deltas because short puts are bullish trades. Bullish trades always have positive delta. Bearish trades always have negative delta. So I'm leaning bullish. I know on a short put, I want AMD to go up, and it is going up today. Let's imagine it goes up by $1 today. How much money do I stand to make on this? Well, $6, because I have 6 long deltas, all other factors being equal. Now, there's other factors, of course, to an options pricing. There's time, theta, right? And then there's volatility, vega, right? So those will affect options pricing, because really options pricing is about 3 things. It's about the price, the time, and the volatility, right? But, you can only control what you can control. And when you enter a trade, just make sure you're comfortable with the deltas when you first open a trade. For me, when I go and sell a put, for example, a lot of times I like somewhere around 15 to 20 deltas. And if I'd have sold a 15 or 20 delta put, and now it's a 6 delta put, I know I got the move right. The stock has moved in the direction I wanted. This is probably a winning trade. It might be time for me to go ahead and take this thing off. When I check my positions after market opens every morning, the first thing I do is I look at the deltas on some of these positions, especially strangles, iron condors, the delta neutral trades. The delta on the trade is very important. For example, right now I have a strangle on in the micro crude oil futures, and these, if I move my head out of the way so you can actually see the total deltas, you can see the deltas on this trade. The total deltas are 12 long deltas, because the short puts have 21 long deltas, but the short calls only have 10 short deltas. So overall, what this means is crude oil has moved lower, meaning the puts have gained delta while the calls have lost delta. So now the whole trade has positive deltas, right? And I put this on probably as a delta neutral trade. So now, it's moved down. Now I'm leaning long because I have these positive deltas. So it tells me exactly what has happened. I already know. Without looking at a chart, crude oil has moved down in the last few days because I have these long deltas that I didn't have before, so I need the underlying stock to go back up, right? It also tells me if I'm in a lot of trouble. For example, if I woke up one day and say the total deltas on this strangle were at 20 or 25 or 30, I know it has moved greatly against me to the downside, and then I might need to go ahead and roll the position. In this case, I'm not going to roll this. It's okay for now. Taking a look at some other positions. How about APLD, which is Applied Digital? Got short puts. Typically, I sell these puts, again, around the 15 to 20 delta range. A lot of times. Sometimes it'll vary. But let's imagine I sold some 20 delta puts, and now they're 14 delta puts. You would expect me to win a little money on them, and I have. I'm at 16% max profit already on this position in just 3 days because I've gotten the direction right? So it's pretty easy. You really need to, first thing you do when you look at these positions, obviously you're probably going to look at your P&L, but look at the deltas, right? So Delta Airline here, got a strangle. What are the total deltas on the Delta trade, right? Well, 9 total long deltas. So I've got long deltas. What does that mean? That means Delta Airlines has been moving down. So the puts their deltas are going up, while the calls, their deltas are going down. So again, without me, I never go and look at the chart. I could go look at the chart and I could tell you delta's probably gone down, right? But I don't need to go look at the chart, because I know if this was something that was a delta neutral trade, say yesterday, and now I've got 9 long deltas, it means the stock has moved down, which obviously it's moving down today. One of the things that delta tells you is your share equivalency. So this is very important. So if I go into Intel, I've got short puts here, and these short puts are at the 10 delta, meaning that the short puts here are like me owning 10 shares of Intel. If I get 3 of them, I'm essentially long 30 shares of Intel. Now, would I be comfortable being long 30 shares of Intel? In this case, yes. But if it was a stock, maybe I wouldn't be comfortable being long whatever amount of shares I would be long or short, because if you had short deltas, you'd be short that amount of shares. So if I had 3 short calls, right, that had negative 10 deltas, that would be like being short 30 shares of Intel. So again, it gives you that share equivalency, and if you're not comfortable with the share equivalency aspect, then you need to do something, right? You need to roll the strikes up or down, get the share equivalency, get the delta back to something more respectable. Maybe I don't like being so long Intel in this case, which I'm not really that long Intel, but let's imagine I wanted to reduce these deltas. What could I do? Well, I could go add some negative deltas. Negative deltas will take away the positive deltas, right? I could go sell maybe 1 call, right, against the 3 short puts. But this 1 call is going to reduce my deltas by 21. So if I had 30 long deltas and then 21 short deltas, now overall the position's going to have what? 9 positive deltas. So I went from being long a share equivalency of 30 shares of Intel to only 9 shares of Intel. So it's all about risk, right? Delta tells you the risk on the trade. It tells you your directional risk, whether you're bullish or bearish, whether you're long or short the stock, and it tells you how long or short the stock you are. And if you don't like being as long or short the stock as you currently are, you can do something about it. That's the great thing with options. It's very, very flexible. You can end up in any position that you want to be in, and it's very easy to make these adjustments with options. And obviously, Delta tells you your likelihood of finishing in the money on the trade. So if I'm selling a put, obviously I want to finish out of the money. Let me go to a ticker I don't have a position in. Let's go to Apple. So let's go to the 64-day cycle, and typically I like selling around the 15 delta put. So if I sell the 15 delta put without looking at probabilities, I know that I'm going to have around an 85% chance of winning on this trade at expiration if I hold it all the way to expiration, which I never do. But I know I've got about an 85% chance of winning on the trade. Why? Because it's a 15 delta short put. 15 deltas means I have about a 15% chance of finishing in the money, which is a losing trade if it's a short option, right? So I know I've got an 85% chance of finishing out of the money, which would be a winning trade. Now, what is my actual probability of profit? 86%. So it's really, really close. So you don't even really have to look at these numbers. The deltas on the options chains, they give you a really pretty accurate representation of your probabilities on the trade. Now for me, I always manage my positions at 50% max profit. So what's the probability of this thing reaching 50% max profit over the life of the trade? 93%, right? So 93%, I'm going to take this thing off at a 50% winner. Really high probability trade. That's why I typically sell puts around the 15 delta mark, is because you're going to win more than 9 times out of 10 on them. One thing to note is typically the 50 delta options are your at the money options. So these are the at the money call and put, and you can see at the money call has a 51 delta, the at the money puts a 50 delta. They're right around 50 deltas. So that's very important to know. If you're below 50 deltas, you're out of the money, right? If you're at 50 deltas, you should be worried because now you're at the money. And if you're above 50 deltas, in this case 78 delta call, 85 delta put, you know, these are in the money options, which are very dangerous obviously if you're short options. So that's something to note. That's another reason why you should go look at the deltas on these positions. Anything that's above a 50 delta is already in the money. It's in trouble. You need to do something with that position. Now if you're using TASTYTRADE as your broker, A lot of times they will have a yellow square next to the ticker symbol. It will say ITM, meaning in the money. It means there's an option somewhere in here that is in the money. You need to go address it. Now, right now, I don't have any in the money options because it's pretty rare for me to have any in the money options. If I'm mostly staying way out of the money, around 15 to 20 deltas, I'm not going to wake up very often and have some in the money options. But when it does happen, they need to be addressed, right? Because if I sell, for example, I go back to Apple here. Let's imagine I sold a 15 delta put, and all of a sudden I wake up one day and Apple has gone down and my 15 delta put's now a 50 delta put. I'm in trouble. What do I need to do? Well, at the very least, I need to reduce this delta, right? 50 deltas is way too long for me. I was comfortable being long 15 deltas, but 50 deltas is a lot more risk. Well, I need to reduce these deltas. How do I reduce these deltas? Well, I could go sell a 25 delta call, and I just cut these deltas in half, right? Because now the 50 long deltas and the 25 short deltas, my overall long deltas on the trade now have gone from 50 to just 25. I've cut that risk, that directional risk, by half by just going and selling the call. And this is why you have to know your deltas, right? All of the options, pricing, everything that's going on with your portfolio, the delta tells you exactly what's going on. It tells you if you're bullish or bearish. It tells you how much risk you actually have on the trade. It tells you if the trade is actually working for you or not, which obviously you need to know. Now, if you want to learn more about Delta and the other options Greeks, check out my book, The Super Wheel Option Strategy. This book is available on Amazon. There's a chapter in this book where I cover the basic option Greeks, cover the basics of Delta, Theta, Gamma, and Vega, and I simplify things, especially if you're brand new to options trading. I explain these topics in very easy to understand terms. You'll find a link to that book in the description below. Peace, guys.